everybody for coming to Luohan webinar. Today, we are very pleased to have the Professor Agostino Caponi. Agostino Caponi is Associate Professor of Industrial Engineering and Operations Research at Columbia University. Professor Caponi is also a Fellow of the Crypto and Blockchain Economic Research Forum, an Academic Fellow of the Luohan Academy, and also External Research Fellow at the FinTech at Cornell Center. Professor Caponi received many prestigious awards, including but not limited to the NSF Career Award and 2019 JP Morgan AI Faculty Research Award. And he is currently serving as a member of an editorial board for many academic journals. For instance, editor of Management Science in the Finance Department and co-editor of Mathematics and Financial Economics, and the Financial Engineering area, editor of Operations Research Letters. Professor Caponi's research interests are in networks, systematic risk, and financial stability, and market microstructure. His papers were published in multiple leading peer-reviewed journals. And today, he's going to talk about his paper, The Information Content of Blockchain Fees. Professor Caponi, the floor is yours.
Great. Thank you so much. Thank you for the quite nice introduction. And also thanks for the opportunity to speak at this webinar. I'm quite pleased to present this new work that has actually recently been finished. So I really welcome feedback and comments because we're trying to improve the draft based on all the feedback and comments that we receive. And I think this is a great audience to present this work. And that's joint work with Rizé Jia, a PhD student at Columbia, and Xiao Hu, who is recently joined as a postdoc and is also here on this webinar. The objective of this paper is to understand what is the information content of blockchain fees. So as we know, every time you have to make a transaction on blockchain on a distributed ledger, you have to submit a fee coming up with this transaction to gain your priority. And the question is, okay, do this fee carry any information? And that's what we want to study in this paper. So I would start with a brief introduction, and I really want to draw the analogy with traditional market microstructure literature and classical financial technology that is used, and we are all familiar with centralized exchange, like many of you have worked on various form of market making or high frequency trading, and we all know what a centralized exchange is. It basically runs a central limit order book where the orders are executed continuously. So an important characteristics of this exchange is that market orders, when you want to execute quickly, then you submit a market order so that the order is immediately matched in the limit order book and executed. And these are not visible ex ante, right? You only see the orders after the execution happened, but you don't see the order before the execution occurs. And what HFT does, like frequency traders, typically they compete on speed. In fact, we have seen over the years that they have improved and got better in technology. They are for example, co-locating their terminals close to the servers of the exchange, because this will let them submit their orders or make sure that the orders reach the exchange quickly. And because the policy that is used by the sequencer on the exchange is a first in, first out, meaning if you submit your order first, then it will be routed first to the matching engine. Then it's important to be quick and fast when you execute. By contrast, a new type of financial innovation that has emerged recently is the so-called decentralized exchange. So the centralized exchange, it runs differently from a centralized limit order book. The main idea is that all the liquidity is pulled together. So there is a lot of, the equivalent of the HFT will be the liquidity providers who all deposit tokens in the pool. And then this pool will basically contain, will be deep if many tokens have been deposited, and traders will be able to exchange token directly by swapping one for the other in the pool. And the price is typically determined by the so-called automated market maker. So the price is exogenously specified by a curve. Like, for example, if some of you have looked at Uniswap, they use the constant product curve, which means that the product of the reserves of, let's say, a token A and token B, token A could be Ethereum, token B could be Bitcoin, it has to be equal to a constant before and after the trade. So there is no there is no competition really over the prices, as you see in centralized limit order book, where market makers are competing by setting bid and ask. Here, the price is exogenous specified. Like we're not really looking at in detail at the market microstructure of DEX here, and there are many papers who do a very good job at describing this new type of financial innovation that has emerged quite recently. But for the purpose of this talk, what is important is that in a DEX, if you want to execute orders, these orders will not be executed continuously on time like it happens with centralized exchanges, but rather they will be executed discretely in blocks. So every pretty much 13 seconds, like just to quote the example of the Ethereum blockchain, the orders are processed. And what is important is that they are processed in order of decreasing fee. So if you want to get your order executed quickly and you want your orders to be at the top, quickly means if you want your order to be at the top of the block when the block is constructed, then you would better attach a larger fee, because that will be used by the validators as a reward. So if you attach a larger fee, as a validator, I will have a stronger incentive to put your order at the top of the block. Okay, so that's like already a very important distinction with centralized exchange, that here really the competition is not really on speed, but it's really on the fee that you pay to get your order executed. And another important distinction is that the orders submitted to the decentralized exchange, these are will go in a so-called memory pool. So each validator has his own memory. All this, the memory contains all the orders that have been broadcast over the chain, and they will be visible to everybody. So if you join this blockchain, and if it's as it's the case, a permissionless blockchain, everybody will be able to join it to be able to see these orders. Right, so that's really another important distinction with respect to centralized limit order books, where you only see the orders after they have been executed. Here you see the orders while they are waiting to be executed, while they are waited, while they are like waiting to get selected for the block by the validators. Okay. Now, this decentralized exchange started roughly around the middle of 2020. So that's when they took off, and the trading volume has been increasing steadily, and it reached like around 50 billion USD at minimum, and even went above that. It reached up to 200 billion. And this, just to put it in perspective with the trading volume on the centralized exchange, is around 10% up to 25% of the trading volume that you see on the centralized exchange. So centralized exchanges are definitely still the exchange where most of the traffic is, but the centralized exchanges are still accounting for a non-negligible part of the trading volume on the crypto space. Okay, now, what are the questions that we aim at answering in this paper is, first of all, we want to really exploit what is unique about the centralized exchange and what is unique about like transacting on blockchain, which is exactly this fee that you need to pay to gain priority. And the first question is, we want to understand whether there is any information embedded into the fee. And then if, like, depending on the answer to this question, like if this is the case, suppose that the fee contains information, then we want to see, okay, where is most of the information captured? Is it in high fee trades or in low fee trades? So if you take an order flow where the attached fee is large, does it mean that this conveys more information? Does it reveal, for example, more private information? Or instead, they are responding to public information such as announcement on, like, say, Bitcoin or Ethereum that you see revealed, that you see released on public media. And finally, we want to see we can construct an economic channels, and this is still like a work in progress that we are doing, to understand what how we can explain the results that we're getting. And the main results that we have are the following. First, like, we can show that econometrically, that the higher is the fee and the more is the private information that you see in these DEX trades. We also can show that if we have higher fee, then it means that for an order, that means that this DEX trade, this trade executed on the centralized exchange, is more sensitive to any change in the centralized in the prices on the centralized exchange. So in a way, it's more sensitive to public information release because we interpret changes in the price on the centralized exchange as like signals of public information, right? Because you can trade quickly, you can trade in a continuous manner and take advantage of this opportunity. And finally, we asked the question, okay, why are these fees? So I mean, why are the traders on DEXs bidding high fees? And is it because of competition with other traders, or is it because of other reasons? And what we show is that these high fees are actually not the result of competition between different traders who are trying to exploit either public information, signal, or private information. We can exclude this form of competition. Okay, so now let me dive into brief literature review, where I want to highlight what we really do in terms of contribution, and then I want to discuss the data set that we're using and the results that we obtain. So there is a large literature, like of course, on the information, on the information content of trades. I mean, this is like really very old, and it has been like subject of extensive investigation, as many of you know. For example, like there are the papers by O'Hara, Isley, and O'Hara, Hiao, we have looked at like block trades versus non-block trades, which one are more informed, or odd lot trade versus round lot trades, which is essentially an update of the earlier paper, where they also take into account for the fact that you can split your order strategically if you have a large order, so that you minimize price impact. And in fact, they find that odd lot trades actually end up containing more private information than round lot trades. But again, this is in the context of traditional exchange. And of course, there are also other literature like by Berkeley, Endershot, and McCormick, who have shown that compare trades executed on the ECN network versus the NASDAQ. So what we do here, like compared to these papers, is we really look at as I mentioned before, at the fee that is like the signal that is used to understand whether or not there is private information or public information. And what we study is precisely what's the private information content that is conveyed by the traders when they bid these fees. And this fee is really a new public signal that is publicly observable by everybody. So that's really what is unique about this decentralized exchange. There is also, of course, a lot of literature about arbitrageurs respond to public information, and like how does it affect price efficiency, market quality, liquidity, etc. Again, there are many papers here in this context. What we contribute, our contribution compared to these papers is really to exploit the fact that decentralized exchanges are not running in continuous time. So the processing of order is not a serial order processing, like first in, first out, but rather these DEXs are executed. The trades on this decentralized exchange are only executed at discrete times when the block is validated and appended to the chain, and the selection criteria is not speed, but is the fee. And what we want to see is what is the impact of this trading mechanism on the efficiency of prices on the centralized exchange. How quickly do the decentralized exchanges track the prices that tracks the change in prices that we see on centralized exchanges? Like if they are fast in adapting, in aligning with the prices on centralized exchange. So this means that there is like more efficiency in terms of price adjustment. And of course, there is also a stream of literature which has emerged recently about just decentralized exchange and the role of fees to provide incentive for trading and to provide incentive for depositing tokens, so depositing liquidity in the pool. And I mean, in a previous work with Rizja, we have also looked at this role of the fee in incentivize the pool and the liquidity providers to deposit. And there are many other papers that have emerged also recently, or a few other papers, I have to say, which look at the fee and the role in, for example, like preventing or mitigating sandwich attacks, or like the role of the fee in attracting liquidity from a centralized to a decentralized exchange. Here, like our focus is more really on the information content of the fee rather than on the role of the fee to incentivize trading or liquidity provision. And that's the space where we make a contribution. Okay, so now I want to really dive into the main results of the paper, but before I do that, I want to discuss the data and also the empirical methodology that we are using to obtain the results. So what we have two types of data that we are using. First, we look at like centralized exchange data, and also we look at decentralized exchange data, because again, we want to look at the transmission channel of information between the centralized exchange and the decentralized exchange. So how, like, example, trade flows on the DEXs are impacting prices on the centralized exchange. And we pick the largest centralized exchange for the analysis, which is Binance. And we pick the largest decentralized exchange for the analysis, which is Uniswap. That's like one of the main DEXs. By far, it was the first to be developed, and it's also the largest in terms of volume, in terms of depth of the pool. And we also focus on 8 token pairs, which essentially are the most actively traded pair in the period that we have run the analysis, which runs from November 1st, 2020 until March 24. Okay, so now if we look at Binance and Uniswap, so again, Binance is a centralized exchange, Uniswap is a decentralized exchange. For both of them, we know what is the timestamp, so when the order has been executed, what's the size of the order, and what's the price at which the order has been executed. So these are like 3 data points that we can get. And if we think about Uniswap, which is a decentralized exchange, we additionally have other information which is specific to the fact that these trades are happening on the distributed ledger on the blockchain. In fact, we know what's the number of the block. So every block, once it's appended to the chain, it has a number. We also know the address of the trader which is submitting the order. We have the transaction nonce. Essentially, the transaction nonce is the specific like transaction of the trader. Like if the trader submits 5 transactions, different transactions, each of them will have a different nonce. And we also know the fee that is paid, and the fee is characterized by the gas price and the gas used. Like so essentially, it's like when you drive a car, if you have to go from one location to another, you have to pay for gas, and depending on how far it is, you have to pay a larger amount of gas. So if you have a large complex order, which takes a lot of computational power to be executed, that means that the used gas is larger with respect to a very simple order that, for example, just is implemented by smart contract, which just says do nothing. Like then you don't really need to spend any, the fee is really small because the gas used is small. And these 8 token pairs that we have like enough variation to look at whether like this is a stable, not stable, or not stable pair. So that means that we can really look at how, let's say, the volatility of the pair is impacting the results. For example, like stable pairs are like consist of tokens which are pegged to the dollar, USDC, USDT, this is Tether, and USD coin. These are both like pegged to the $1. So these are essentially the digital equivalent of a dollar. And as a result, their volatility is low compared to tokens such as Ethereum or Bitcoin, which are not really pegged to any like physical currency. And like the segmentation that we exploit is basically in terms of stable, like no stable, which means that one of the currency pair, one of the token in the pair is a stable coin. And then we have no stable, which means that both tokens in the pair are unstable coins. For example, rough Bitcoin versus Ethereum, like these are both classified as no stable coins.
Can I ask you a simple question?
Yeah, absolutely.
Yeah, I'm kind of unfamiliar with the cryptocurrency, actually the institution. So stable seems like it's backed by physical asset. That's what you call stable. So right. Stable is not backed by anything. Right. So a stable, that's a good question. So a stable coin in general is a collateralized coin. It's backed by either like CDs and certificate deposits, or it's backed by physical treasury securities, or it could be backed by the currency itself, like by the dollars, for instance. So it's like the way to think about a stable coin is to think about a collateralized asset. A 100%, in principle, if it's really stable
And there has been some discussion about whether or not these are stable, because in principle, they are supposed to be 100% collateralized, but there has been some studies which have shown that they are like not as well collateralized as they claim to be. But the basic idea is that these are like collateralized by physical assets, whereas the other pairs, the other tokens are not.
Okay, yeah, and why are you looking at the pair of tokens, not just like a one by each? Is there some special reason?
I see. Oh, that's another great question. So why look at pair instead of individual tokens? And the reason is that these exchanges are essentially, they support trading of swaps, meaning when you want to trade on this exchange, you can swap one token for another. For example, suppose that you have 10 Bitcoin and you want to get some Ethereum. So you go to this exchange, you look at the exchange rate between Bitcoin and Ethereum, and then you will be able to put in Bitcoin and take out Ethereum. So that's
also
yeah, go ahead.
So there's a price for every pair of Bitcoins.
Exactly. So the idea is that every exchange is managing a pair of coins. For example, like Uniswap is running several automated market makers. Each automated market maker is managing a pair of coins. So if you are interested in trading USDCs for USDT, then you go into the pool where the deposited tokens are USDC and USDT, and you will swap USDC for USDT, or vice versa. You can swap USDT for USDC. If you are interested in, for example, extracting from the pool Ethereum token because you want to run some applications on the Ethereum network, on the Ethereum blockchain, then you go into a pool which is exchanging Ethereum for the token you have. For example, if you have Bitcoin, then you go into the pool which is supporting exchange of Ethereum for Bitcoin, and you will be able to deposit Bitcoin and take out Ethereum.
Okay, yeah, thank you.
Does it make sense? So that's why we have pairs of tokens. Yeah. So it's like an exchange, really like a foreign exchange market where you can swap one currency for another. Like the same is true for this exchange, crypto exchange. So this is like the data I said. This is the data on executed trades. So these are the trades that have been executed and therefore are visible on the chain, right? Because when a trade is executed, it's appended on the chain. But we also have transit in a way orders, which we call what we call the mempool orders. These are orders that have been submitted by the traders on the chain, on the blockchain, but they have not yet been executed. Right? Because as I mentioned before at the very beginning of the presentation, if you want to trade on a decentralized exchange, you first need to submit your orders. These orders will be sitting in this public mempool. And then when the validator decides to append the next block on the chain, we'll pick some of these orders from the public mempool and we'll execute them. So basically the life cycle of an order is first it's pending in this public mempool, and then it will be executed. So we also have access to the mempool orders data for these 8 token pairs that we're analyzing for a slightly smaller time period. So it's from February 7 through March 24. Like what we have for these orders is the timestamp. So when the orders has been submitted on the chain, what's the address of the trader who has submitted the order, what is the transaction nonce, and what is the gas price and the gas used. So I want to make a few remarks about this transaction nonce, which is it's like more an implementation detail of these distributed ledgers, but I think it's useful to understand how they work exactly, because it could clarify some of the points as we proceed with the presentation. So essentially what happens is that each trader, when he starts executing transaction, each new transaction will have a different nonce. But the nonces can only be used once, and they must be in an increasing order. Like you submit your first transaction, it has a nonce, then you submit another transaction that will have nonce 2, then you submit a third transaction which will have nonce 3, and so on. But what is important is that an order which has a larger nonce will not be able to be executed before an order which has a smaller nonce. So suppose that there is nonce 1 and nonce 2. Nonce 2 has not been executed yet for this trader. If you submit a transaction which has nonce 3, this transaction will never be executed unless the nonce 2 has already been executed, right? You really need to respect this sequencing. So that means that if a trader wants to speed up his pending order, he submitted an order on the public mempool, he has been waiting for some time, and now he says, okay, I want to make sure that this order is executed quickly. So what he has to do, he has to broadcast a new order with the same nonce, but with a larger gas fee, right? So for example, I say, okay, I wanted to swap Bitcoin for Ethereum. I submitted a low fee, and now I'm seeing that I'm waiting too long. So let me submit exactly the same order where I want to swap again Bitcoin for Ethereum, but I will double the fee, or I will make the fee 3 times as larger. So what will happen is that the validator, when he has to append the block, he will pick this order now because it has a larger fee. And because each nonce can only be used once, it means that the stale order will be essentially never executed. So we will go to the next nonce. Okay, so that's how the order works. Okay, so now let me discuss the empirical methodology. We use a structural VAR model, which has like the following specification. We have an endogenous vector of variables that I will specify in a minute. We have a structural matrix A, which captures the contemporaneous correlations between the different endogenous variables in the system. And we have like system matrices, phi1, phi2, and phi-p, and structural innovations are assumed to be uncorrelated and zero mean, as usual. So what is important is to specify, okay, what is our vector of endogenous variable? And again, here the focus is to understand the transmission channel of information between decentralized exchanges and centralized exchange. So we have the key variables are the return on the centralized exchange, and then the trading flows on the decentralized exchange. And because the focus is really on the fee, we are partitioning the trading orders into low fee, mid fee, and high fee, depending on what is the size, the size of the fee that is attached to it with the order. And I will have to say more about how we perform this breakdown in the next slide. The time for the time here is the block time. So we really like time 1 will be the time where the first block is validated and appended to the chain. Time 2 is the time when the second block is appended and validated to the chain. So this is not physical time. This is the block time, which means the time where the blocks are appended to the chain. And yeah, the flows are essentially computed by looking at by netting all the trading flows that are submitted on the same block T for this specific fee. So for example, like if there is a buy order of 100 Bitcoin for Ethereum, and then there is a sell order of 50 Bitcoin for Ethereum, then the net flow will be a buy order of 50 Bitcoins for Ethereum, right? So we sum up all the trading flows, like plus corresponds for buy, minus corresponds for sell. Again, we look at the net amount, because if an order is informed, then typically the trading is directional, right? So you expect the order flow to go up. Now, the next specification that we have to discuss is the contemporaneous correlation matrix. And here I want to make a few observations. So we are essentially making an assumption on the causality, on the direction of the causality. We're assuming that the trade flow variables are causing the return on the centralized exchange. So the flow is going from DEX to SEX, but not vice versa, as you can see from the metric specification. And we are also imposing a relation between low fee, mid fee, and high fee DEX trading flows. So we say that low fee DEX trade flows are causing mid and high fee DEX trade flows, and mid DEX trade flows are causing high fee DEX trading flows. Like this ordering of causality for the low fee versus like high fee DEX trading flows is essentially giving us a lower bound on the price impact of the high fee trade flows, right? Because in the equation for the high fee trading flow, we are controlling also for the middle fee and low fee trading flows, which means that the innovation like might be smaller than what would have been the case if we were like not controlling for these variables at all. Okay, so now let me explain how we design, how we construct these blocks of low fee or these groups of low fee, middle fee, and high fee trading flows. So we look at the current block T, and now an order that that comes in this block, if it's like a DEX order, Then we have to decide whether or not it belongs to the low fee, middle fee, or high fee block. So how do? We first have to construct the blocks, and to construct the blocks, we use a sliding window approach, which means that we look at the last 20 non-empty blocks that have been validated. Like we have also, and Xiao has experimented with different numbers instead of 20. Let's look at the last 5 or 10, and the results do not really change qualitatively. But here, so I think we have like the last 20 non-empty blocks, which means from block T minus 20 to block T minus 1. And then we rank order all these trades in descending order of their fees. So the first one will be the one with the largest fee. The last one will be the one with the smallest fee. So then we construct the quartiles, right? The 75% quantile, the 25% quantile, and we say that any trade submitted in the current block time T, which is higher than the 75% quantile, then it will be classified in the high fee group. Every trading order whose fee is lower than the 25% quantile will be classified into the low fee DEX trading block. And all the other orders, which are like higher, whose fee is higher than 25% quantile, but lower than the 75% quantile, will be classified in the so-called middle fee trade flow group. So really here, the focus is really to compare high fee versus low fee, but like we want a separation between the two. That's why we construct also the middle fee group. Okay, so that's like, it's a sliding window, because as we move on, like the blocks, the definition of the quantile will change, because it will depend exactly on the fee of these new orders that are submitted in the current blocks. Okay, so next step is to look at the how we set up the time convention. As I mentioned, like there is a somewhat different notion of time between centralized and decentralized exchange, because for decentralized exchange, as I mentioned before, and this is the time step convention that we're using in the structural VAR, the time is really intended to be block time. But of course, if we think about the centralized exchange, right, the time is running continuously, right? Because this doesn't work in terms of like block time. This works in terms of continuous processing orders. So in order to align these times, when we look at the return on the centralized exchange, what we do is we take the price of the last trade on Binance for that specific pair that we are analyzing just before the last block has been mined, and the same price and the price of the last trade done on Binance just before this last block has been validated. So we look at the difference in terms of log prices between the last Binance trade before mining this block at time T and the price of the last Binance trade before mining the previous block, and this will be used to compute the return, so that we are essentially on the same time scale as the block time that is being used to design the VAR for DEX trades. And yeah, so that's essentially that's the main. I mean, that's the way that's an implementation detail, but I think it's important because we want to make sure that the times are aligned. Okay, so next step is to design or define what is the permanent price impact and then the information share of a trade. Okay, the objective is really to look at how informative trades are, how informative DEX flows are. And here we are like standing on the shoulders of giants. I was looking at the methodology that was proposed by Joel Asbrook in 1991 on how to measure the permanent price impact of a DEX of a trade, and then how to use this permanent price impact measure to define the amount of information that is embedded into the trade. So well, the idea is that the permanent price impact of a DEX trade flow variable, for example, of a low fee, middle fee, or high fee trading flow, is defined as the cumulative impulse response of the centralized exchange return to a unit shock in the flow variable. So we apply, let's say, a shock to the trade flow variable, for example, we assume that the trade flow variable increases by 1 standard deviation of its current value, and then we look at what is the amount, the number of basis points by which the return on the centralized exchange increases in response to this shock. And this will not be just the increase in the next period, but also summing up all the increases, because of course, if, for example, the price increases in the next block period, but then decreases into blocks, this might not be actually an indication that there is information. It might be more an indication that this was a trader. I mean, this was a liquidity trade, which has been then reverted, then the price has been reverted back immediately in the next period. So the permanent price impact really should look at the cumulative impulse response of the return to the flow. And just to be clear, like in our result that I'm going to present, when we apply a shock to the exchange return, it means that we are increasing the return on the exchange by 1 basis point. Instead, when we apply a shock to the trade flow variable, we mean really what's the standard deviation increase in terms of its current value for that trade flow variable. And and then of course this can be computed explicitly by looking at the moving average representation of a structural VAR. This turns out to be the first. I mean, if we are looking at the Kate variable, for example, the K could be 2, 3, or 4, depending on whether it's a low fee, middle fee, or high fee trade flow variable. Like we look at the first row and the Kate column of this matrix, and this will give us exactly the value of the permanent price impact caused by a shock to that trade flow variable. And once we have that, we are ready to define what's the information share of either like a DEX trade flow variable or of the centralized exchange return. This is essentially obtained by measuring the permanent price impact square by the innovation variance, the variance of the innovation or of the shock to that trade flow variable, of course, normalized by the cumulative sum of price impacts, permanent price impact square times innovation variance of all the other variables that we have in the model. The idea being is that if like a trade flow variable is very informative, that means that it will have a large permanent price impact, like when you apply a shock to it. And of course, it will also have a large variance because like typically trades which have like a large variability, it means the trade flow variables which have large variability means that they are more driven by information rather than by, say, some allocation or liquidity reasons where you need, for example, to make a margin call at the end of every day, and therefore you will be liquidating the same amount every day. Okay, good. So now I want to go and discuss what are the empirical results. Remember, the objective of this paper was to understand whether or not these fees are conveying any private information and whether or not there is any response of or sensitivity to public information. Okay, so first I want to start with discussing some summary statistics for these trade flow variables. They are all denominated in $1,000 USD, and like these are like for stable coins. You see what's the mean, what is the standard deviation of returns, and also what is the mean and standard deviation of the low fee, middle fee, and high fee trade variables. And then we have the corresponding like variables for the statistics for the stable, unstable pairs, and we also have the corresponding statistic for unstable pairs. So I think some takeaways from this from this table is that if you look at centralized exchange return and you compare it with decentralized you look at standard deviation, typically this is like smaller for stable coins compared to like unstable pairs. Like if you look at the mean and the standard deviation, typically is lower for stable pairs traded on the centralized exchange rather than unstable pairs or stable unstable pairs. And the other important observation is that typically the flow on the decentralized exchange is larger for unstable pairs or stable unstable pairs, whereas the flow for stable pairs is larger on the centralized exchange. The idea is that typically we see larger trades of stable pairs on centralized exchange because like you can exploit more public information. Whereas if you think about unstable pairs, these are like mostly traded, or they are definitely they have a larger trading volume on the decentralized exchange. And this is reflected, for example, in these statistics where you see that the DEX flow is larger on the decentralized exchange relative to the centralized exchange for pretty much all unstable pairs or stable and unstable pairs. The other important characteristic that I want to notice in this data set is that if you look at the trade sizes, we see that typically the high fee flows have a larger trading size than the low fee flows. Like if you compare between the two, for example, for this table where I'm only reporting the non-stable pairs, you see that the absolute value of the net trading flow and the standard deviation is larger for high fee compared to low fee trading flow, with the idea being that like typically high fee trading flow also come with a larger size in absolute value. Okay, so these are just some interesting statistics of the data. So now let me report what are the main results from the structural VAR analysis. So the first result that I want to report or to discuss is what's the permanent price impact of DEX trade flows. So now the way to read this table is to think about the column as the variable that is being shocked. For example, what if you shock by 1 basis point the centralized exchange return? Then you want to look at what is the cumulative impulse response of the centralized exchange return with respect to a shock to itself in the previous period. Or suppose that you shock by 1 standard deviation the low fee or mid fee or high fee DEX flows. What's the cumulative impulse response on the centralized exchange return after like this shock has been applied? So if we focus like on the first column here, what we see, or sorry, on the first row here, we are basically looking at the stable pairs. And what we see is that really the shocks to the trading flow on the DEX are really not impacting at all the centralized exchange return, right? So there is no response, like the regression coefficients are statistically insignificant and they are also very small or close to zero. The idea being is that like there is no permanent price impact on the really on when there is a shock to these DEX flows if these trades involve stable pairs, and this is because these are really driven mostly by public information. So there is really no private.
Professor Caponi, is there a typo? I think is the return of DEX on the variable, right? Because you cannot request on yourself. I mean, on the left first column is RTDX, right? Yes, a DEX.
Here, you mean?
No, on the next line is the top should be a return on the DEX exchange, right? You're requesting return on the DEX exchange on the centralized exchange, right?
You mean the title of the table?
Yeah, I think you have the response of CX return.
Yeah.
You have to see this RTCX. I mean, is that regression itself? It's probably DEX, right?
No, let me, maybe the table is like, might be a little bit confusing. So here, what I'm saying is that like the response variable here is the centralized exchange return, and we want to see what's the cumulative impulse response on the centralized exchange return, which is the sum of this derivative of the centralized exchange return with respect to shocks to these variables. So at time t, you increase by 1 basis point the centralized exchange return, or you increase by 1 standard deviation one of these variables, like suppose that you increase the low fee DEX trade flow, and then you want to see what's the change in the centralized exchange return in the next period, in 2 periods from now, 3 periods from now, etc. So that's
so it's t minus 1.
Right? I agree. It could be. Right. I think the way to think again is always keeping in mind the structural VAR. This is always like you apply a shock at time t minus 1, and then you see what's the response of the variable at time t. Always.
Oh yeah, because you have the same like time notation. I was confused. I thought maybe it's like DEX, return on the DEX.
Right.
So it's return. It's the return on the centralized exchange, except it's a lag. Right?
Yeah, exactly. It's the lag.
Okay. No problem.
These are the lag exactly. These are the how the centralized exchange return responds to the lagged shock, to the shock, I mean, to their lags from previous period to periods, etc. Yeah.
Oh, no problem. No problem.
Yeah. And I think I was just discussing with Xiao about this. Like, it was also I was also like thinking that this could be a better way of rewriting this would be to either avoid t altogether, or to maybe have t-1, as you said, to show that there is like
because otherwise the regression itself is kind of
yeah. No, I agree. Yeah, but I hope it's I totally agree with you. Yeah. I think Marius has a question.
Yeah, Agostino. So when you're doing this separation of order flow, you're just looking at transactions that have been submitted for the public mempool.
Right.
Because there could be big informed traders that they will want to reveal information, and they would submit for flash bots with very low or zero fees. So this is the upper bound of the not so sophisticated people that don't use private relayers to hide information.
Yeah, exactly. Because we agree. I mean, in principle, you could use a flashbot channels to hide your order flow, right?
Yeah, and these guys are more likely to be even more informed.
Yeah,
if they're so sophisticated. Yeah. Okay.
Yeah, I think I was actually trying to type and answer Mario's question, but it was quick. Yeah, I think because I think if I remember correctly, I think the flashbots are they took off actually after March 2021.
Yeah.
So that was actually the very end of our sample period, and we actually discussed about it. So I think the flashbots were not actually used that often during our sample period between let's say November 2020 until the March of 2021. So I think if you use actually a later sample period, that's definitely something we should actually consider, because the flashbot, as you mentioned, that can be actually used by informed traders to hide their information. But I think at least for our sample period we're using right now, that is actually less of a concern for the moment. Yeah, but thanks, it's a great point.
Yeah, it's a great, agree. Yeah, exactly. I think they were introduced around March or April 2021, just after our sample period. But if we expand the time series, I think we should do that. Absolutely. Yeah. That's a good point. And yeah, so just to summarize, like we see, we see that like focusing on the first row, we see that, like, not surprisingly, I would say that DEX trade flows, regardless of their fee level, are not really impacting the centralized exchange return, which means that they don't contain any private information, right? Otherwise, the centralized exchange return would respond to them. And but what is important, what is interesting to notice is that if we focus now on non-stable pairs, like non-stable, non-stable, or non-stable, stable, we see that the fee plays an important role, because high fee DEX trade flows, look at the last row and compare the high fee DEX trade flow with low fee DEX trade flows. We see that the permanent price impact of the high fee DEX trade flow is larger compared to the low fixed DEX trade flow. So that means that really the returns on the centralized exchange are responding more to flow on DEXs which submit high fees, which essentially is an indication that these high fee DEX trade flows are more informed, like are probably informed compared to the low fee DEX trade flows. And the next step is to use this permanent price impact, like, which gives exactly the increasing basis point of the centralized exchange return after a trade flow has been executed. And we want to see, like, whether or not we can classify now the information share of this different trading flow. Of course, the largest information share is really captured by the centralized exchange return. So this means that like the shock to the centralized exchange return has really the largest impact on the centralized exchange return in the next period. But what is interesting to observe here is that if we think about, again, focus on the fee and focus on the group with high fee, we see that for like not stable, or not stable, stable, we see that the information share of high fee DEX trade flows is significantly larger than the information share of low fixed DEX trade flows. For example, if we focus on the last column, it's like 10 times larger, like the information share of the high fee DEX trade flows is 10 times larger, or roughly 10 times larger, as they maybe a little bit less than 10, I would say 7 or maybe 6 or 7 times larger than the information share on low fixed DEX trade flows, which is still a significant fact. Yeah. So then now we do that's how the opposite, like we shock the centralized exchange return. So we increase the centralized exchange return by 1 basis point, and we want to see the response of the DEX trade flows in the next period. Again, these are always lagged, right? For the low fee, middle fee, and high fee. So this will basically allow us to understand whether like the trading flows are responding to public information, right? If we see, because again, innovation or shocks to the centralized exchange returns for us are are basically proxy for public information. And then we want to see whether like the flows are responding to this public information. And again, we want to exploit the segmentation in terms of stable, stable, not stable, not stable, and not stable, not stable. And what we see is that, again, if we look at CX, return innovation on the centralized exchange return, like really the DEX trade flows are not responding to that, right? For stable pairs, because stable pairs, there is not much like information that is being revealed. So that's why you don't observe a significant response. I mean, the results are statistically insignificant and also economically small. But if we look at the not stable, not stable, and not stable, not stable, you see that shocks to the centralized exchange return are actually having an impact on the trading flows on the DEX, especially for high fee DEX trade flows. So for high fee, if we think about not stable, stable, or not stable, not stable, you see that this is like on the order of 4% standard deviation increase of the high fee DEX trade flows compared to like a virtually zero change or a very small change in the low fee DEX trade flows after a shock to the centralized exchange return. So bottom line is that high fee DEX trade flows are more responsive to public information compared to low fee DEX trade flows. Okay, so then we want to look at, remember, one of the questions that I asked at the very beginning is, okay, can we say anything about price efficiency? And my one way to understand price efficiency here is to see how quickly the return on the centralized exchange are responding to DEX trade flows where there is high fee. So the idea is that if the centralized exchange return adjusts quickly to a flow trade on the DEX with high fee, that means that the traders are learning quickly the private information that is embedded into this high fee DEX trade flow. And as a result, they are trading, submitting limit order on the centralized exchange in order to update the market price and align it with the efficient price that basically was determined in the decentralized exchange, right? So the idea is that how quickly does the return on the centralized exchange respond to high fee DEX trade flows, and we will have some graphs to show exactly on the speed at which this adjustment occurs. And what we see, in fact, is that the centralized exchange return are adjusting quickly, pretty much like they are significant. The impulse response function are positive and significant both in the same block and also in the next block, and then they become insignificant from the second block on, which means that they adjust really on the order of one block time. But the other direction is less, is more sticky. I mean, if we look at how DEX trade flows are responding to public information, which essentially is a measure of how the DEX prices are adjusting to the efficient price on the centralized exchange, because now there has been a public information shock on the centralized exchange so that the returns have adjusted to it, but how quickly will the prices on the DEX catch up and also reflect this information, incorporate this information that has been revealed on the centralized exchange return. Here we see that it will take more time, around from 1 to 5 blocks before the DEX price will adjust to the public information that we observe on the centralized exchange return.
There's a question on the chat from Marius. Perhaps you should do a plausible analysis where you split order flow by size. Maybe centralized traders just learn from order flow size rather than fee. I assume the two are correlated. Right. So you're saying that, Marius, if I understand correctly, you're saying that there could be a large correlation between the trade size and the fee.
Yeah, and then maybe you just want to run the same analysis, splitting trades by their size. Maybe people just learn like in normal markets. Yeah,
absolutely. It's a great question. And just yesterday we discussed this point. We had a meeting with Xiao precisely to further decompose the trades in terms of like, I mean, yeah, what in fact we are planning to do, and like we great to hear your feedback, is to construct additional buckets like a large size and small size trades for each specific fee level.
Yeah, another question is, these are all like DEX on Binance chain or on Ethereum chain?
Right, right. The central, yeah, for the centralized exchange, we are only using Binance. For only Binance, the largest exchange, right? We picked only Binance.
What about DEX? What about
for DEX, we are only using Uniswap.
Oh, okay.
Yeah.
So I was thinking like, because on Binance you have like a cake as well, and Ethereum, the transaction fee is much higher. So is there a difference? Because if you want to kind of look at the response of tax trades, if the transaction fee on the Ethereum is much higher than on Binance, maybe on the DEX response on the like cake, which is in Binance chain, has much lower transaction fee, maybe the response will be like faster compared to Uniswap, because you have lower kind of mining fees.
Right. So you are saying instead of only one blockchain, which is Ethereum, let's use also Binance chain, and perhaps we might be able to observe like different results because the response will be different. Like yeah, I agree. I mean, I think this could be a point that for now we are focused only on Ethereum. I agree, because it's largest. There is the largest traffic in terms of trades, but definitely, I think if we had, I think we are trying to get more data, and this could be an analysis that we could run.
Yeah.
Thank you.
Can I ask you a question?
Yeah.
Yeah, I just wanna understand the some environment. So when you talk about the private information, can you give us some example of what type of information that is? Because I'm kind of very unfamiliar with this environment.
Yeah. So private.
And also in this, the cryptocurrency exchange market, the private information, the asymmetric information is considered to be very severe problem. Yeah, this is my second question.
Sorry, what is your second question?
So in this cryptocurrency exchange market, this private asymmetric information, private information, is that like considered to be like some serious problem?
Right. So I think the first question is the way we think about public information is essentially information that is visible to everybody, right? For example, there is an announcement about an example could be, let's say, Ethereum has switched from proof of work to proof of stake, although this was really not a shock because it was already announced. But suppose that there is an information, for example, there is the default of one of the main crypto tokens, like Terra Luna, for example. This could be viewed as a shock, right? That is public information because everybody gets to know it. So it's like publicly announced. It's not that you only know it. Everybody can trade on this information. And because everybody can trade information, our argument is that they will want to do it quickly, and therefore they will go to the centralized exchange where the orders are processed continuously over time. Like an example of a private information is for example, you could be informed, you could have some information about the performance of the Uniswap token because you have been part of the governance board of Uniswap, and therefore you know that there is going to be soon an announcement which will pump up the price. Then you want to exploit this information, like it's private, you only know it, like nobody else know it, or maybe only those few governors who are also part of the board, but nobody else knows. So you want to maybe execute a large trade on a DEX and buy a lot of Uniswap token because you anticipated it will go up in price. And this is like an example of a private information. So you are the only one who knows it. Yeah. So I also want to know whether this private information is considered to make a lot of maybe some problem in this exchange market. By this somewhat like I don't have a yes, if you ask the question, okay, how much this private problems, you mean that could cause some arbitrage or attacks? Or when you say problems, you mean that there could be, for example, attacks or one could exploit private information and pump up a price and, for example, create a problem because there might be all of a sudden like a price which goes up quickly and then it drops down. So that's what you mean, the induced spikes or bubbles in the crypto market.
Okay, yeah, I was just recommending the problem some general term, yeah, some general opinion, yeah, impression, yeah.
Yeah,
Okay.
in principle, we have seen many of these problems in the DEX, right? That there has been a lot of attacks caused by like people, essentially attempts to manipulate the prices. For example, on the centralized exchange, on the decentralized exchange, to perform attacks, for example, to cash out a lot of tokens, like by pumping up the price, swapping, and then selling it right away. So there are a lot of attacks of this form.
Okay. Yeah.
So it's like hackers, like after they hacked the centralized exchange, they want to sell it on the decentralized exchange.
Yeah, you could do that, exactly. Yeah.
But there are also papers by, I think, John Griffin in Texas Austin showing that, USDT issuer, the Tether kind of company, they tend to manipulate the blockchain price because they can issue like new USDTs anytime they want.
Yeah.
Do you have some data on that? Like was able to look at the issuance of new USDT, and was that kind of linked to the centralized exchange or linked to the decentralized exchange? Do we have any data on that? Look at manipulation by USDT issuers.
Right. I mean, this unfortunately we didn't look. We didn't look at that, so we don't have much to say. I think we are more like interested in understanding exactly like how fees are conveying information rather than maybe issuance of tokens or manipulation of prices, profiting of the cross arbitrage between centralized and decentralized exchanges.
Okay.
Hi, Agostino. How are you?
Hi, Lian.
Hey, how are you? I have a few questions, maybe a naive question. So the first one, so I want to make a better connection to the traditional microstructure literature. So if my intuition is correct, maybe this stable coin is similar to like you providing some benchmark price in the OTC market. Think about the bond market, because you connect those crypto to US dollars, you have some relative benchmark price. Or maybe it's kind of the volatility of those non-stable coins higher, so it can be related to the volatility of equity in the stock market. So I want to understand whether there's some connection between your findings and those traditional literature in the equity market and the bond market in terms of benchmarking and return volatility. This is the first question. The second one, so here you see it recovered to the efficient price very quickly. So I don't know how to define the efficient price. Maybe it's like let's think about node trader risk. Maybe this is the next period price is the return is given by the node trader. Is not a fundamental price. Maybe it's just some noise. So the third question. I see the finding that very striking. So those pairs, the high and the low, very, very striking. And I want to know whether there is some finding around some event. So when there's some event happening, maybe those private information become more relevant. You think about probably in China that the regulation that said, okay, you cannot trade those coins in China. But there's some kind of sudden shock. This event happens, maybe the private information become more important. So whether the result will become kind of more striking. Right? So that's three questions. The first one related to the traditional literature. Number two, the efficient price. Number three, the event study. Thank you. A lot of naive questions. Sorry about that.
No, thank you, Lian. I think these are all great questions. I don't think I have a precise answer, but I will make some comments. I mean, these are all points that we should really investigate in more detail. In terms of like analogy with traditional financial markets, yeah, I agree with you that in principle, one could think about stable trades as like being somewhat treasury related trades, like treasury bonds, where there is really a lot. I mean, there is not a lot of private information, but there is mostly public information. Whereas we can think of unstable tokens more like related to traditional equity, and therefore like there is more private information to be exploited, which I think is somewhat somewhat like what we find like in the results, for example, like that like centralized exchange return are not responding to shocks to the DEX flows in stable pairs. This could be put in the analogy with the traditional markets. Like if you see that there are like shocks to the treasury assets, like these are not really like revealing a lot of information that could be used to adjust the price on the centralized exchange, right? This is something I think it's a good analogy. It's not like I think because if we think about the really stable coin, which is 100% collateralized, this is really the equivalent of cash and therefore close to a treasury. Yeah, definitely. But I think we will look at this in more detail. Like for the efficiency, I agree. I think here we didn't really define yet a measure of price efficiency. I think what I meant, and perhaps here we have to be more rigorous and precise, is that if there is a DEX trade flow shock, so it means that the traders have traded, then the price on the DEX has already accounted for this information, and now we define this to be the efficient price, and we want to see how quickly the price on the centralized exchange is adjusting and also tracking this new price, right? So, but I think we don't really, this is, I think what maybe the word efficient here is really a little bit still like a bit vague, but we have to define more precisely what we mean by efficient. Agree. And similarly, I think when we look at the response of DEX trade flows to public information, I think this is the opposite. Suppose that there is a shock to the public news revealed, and the market makers submit limit orders on the centralized exchange, so that the prices are already immediately incorporating this information and are becoming somewhat efficient. And now we want to see how quickly the DEX is adjusting and also aligning to this new efficient price, which is on the centralized exchange. So essentially, we are defining efficiency in terms of like price, which is informationally efficient prices that they already accounted for the information. And now we want to see how the other price, the price on the centralized exchange or on the decentralized exchange, is adjusting to the new efficient price on the others. But I think we don't really have yet defined it precisely. This, I think, is a point that we should work on, Michelle. And the third question is, sorry, what?
The event study.
Exactly.
Yes.
Yeah, this is a great point. We have a limited sample period. I think we didn't really look at what significant shocks we have seen from November 2020 up to March 2021. But I think this is a great question, like seeing exactly around the time of public shocks, like a public information shock, whether or not private information becomes more valuable in the sense that you see higher fee DEX trade flow submitted. This would be extremely interesting. Like the answer here is that we didn't do that, but I think we should.
Thank you. Great.
Yeah, this is excellent feedback. Thank you.
Excuse me, Professor Caponi, can I also ask two questions? Very quick questions. So thanks very much. So my first question is that it seems to me that like public information, private information in the context of like cryptocurrency market is like quite similar to traditional financial market, right? A channel. And I was wondering, does private information matter more for the smaller tokens that are traded in DEX? Because the transaction pairs in your analysis are, I think, all mainstream coins like USDT, USDC, like Bitcoin, Ethereum, like DAI. Right. This is my first question. Like, I don't know, like how. And the second question is that in the context of decentralized exchanges, slippage is another type of transaction cost, I think, and it happens a lot in like that DeFi, right? So do you think that it's important in your analysis? Like, did you take into consideration in the like transaction cost, or like, or you think it's just the minor things? Yeah, thank you.
Yeah, I think that both great questions. Both the first one about about like small tokens versus large tokens. Right, I agree that maybe there is more private information for there could be more private information incorporated into the small tokens compared to large tokens, because like of course there is also more somewhat asymmetric information there. I think here yeah, the reason why we focus on the mostly active trading pairs is because these are like the ones that have a significant trading volume, and therefore like the effects would be more material, like when we run the structural VAR. But I mean, we could, I think it's a great point that I mean, one could zoom out and see also like which pairs have more, I mean, among the unstable pairs, which one have more like private information when you normalize perhaps by the trading volume, like per like unit amount of private information. Yeah, I mean, we didn't do that, but I think we should look into it. I agree. And yeah, the second question is about the slippage. Yeah, I agree that like I mean, I think this is somewhat a good point. And I mean, the fact that there are higher transaction costs on the decentralized exchange due exactly to the reasons that you mentioned, like you have to, first of all, pay a larger fee to get executed onto the block, and also you're exposed to the slippage coming from the fact that when you execute, you are moving the price on the curve, right? So you're going from one point to the other, which is a significant transaction cost. So this definitely is, I mean, one of the reasons why, for example, if there is a public information shock, that's why we think and we say that the response, the traders will respond on the centralized exchange because they want to minimize the cost. So this is also, I think if we look at the summary stat in the paper, we see that the trades on the centralized exchange for stable pairs are significantly larger than on the centralized exchange rather than on the centralized exchange. And one of the reasons is exactly what you said, because if you have to trade like stable coins, you really, why would you go to the centralized exchange and be subject to this large transaction cost, right? There is no reason to do that. That's the reason why I think, and then one of the reasons is exactly this high transaction cost, including slippage and blockchain fee. So that's definitely a good point. And we have incorporated like this transaction cost measure that you mentioned in the analysis about profitability of trades that I will show like next. This will basically be accounted for in the calculation of the revenue, because one of the other analysis that we did is to understand whether like there is competition or not. And like if we want to understand whether or not there is competition, we want to see also whether or not the revenue are eaten up by the competition. And to compute the revenue, we accounted exactly for the higher transaction cost that you see in the DEX because of the slippage.
Thank you. Thank you.
Yeah. Like this is like, these graphs are just like visually showing what I've just said before in words. Like if we look at the adjustment times, maybe let's look at no stable, which is the most striking. I think we see that if we have a shock to the centralized exchange return, then you see that it will take some time, right, around 6 or 7 block time for the high fee DEX freight flow to adjust to it, right? So you see that there is an overshoot and then it's the decrease. But if you look at the first row here, this is how quickly the prices on the centralized exchange are responding to shock to the trading flow. And I mentioned before that they are actually adjusting in the order of 1 or 2 block times. And you see indeed that the time is faster, right? So this is like the speed of adjustment on the centralized exchange is quicker, is smaller than the speed of adjustment on the decentralized exchange. Okay, so now we go to like, we want to say, okay, let's see if we can find out some plausible explanation for the result that we're observing. So why do informed traders pay higher fees? And here we came up with 3 plausible explanations. And if you know it, another explanation, I would be very interesting to hear, because we think that these are the 3 possible channels. But if you think about others, it would be great if you can speak up and let us know. So we think that could be explicit competition. That means that the traders are revising their fees, increasing their fees in order to get executed. For example, I see Marius that has submitted the trade flow with the fee, and then I want to trade before him. So I would submit like another trade with a higher fee because I want to trade before him. And then maybe Luohan will see me and he will submit like a fee which is larger. And then I will revise my quote again because I want to execute before all of them. So this is like the explicit competition where a trader is revising the fee for each trade multiple times after observing what others are doing, right? This is the multiple round fee auction, let's say. Then there could be an implicit, what we call implicit competition, in the sense that I anticipate that there will be competition. I anticipate that Marius and Lian will basically be submitting high fees because they want to execute quickly, and therefore I will start by submitting a large fee ex ante, right? Or there could be just congestion on the blockchain, like I'm submitting a high fee, not much because I'm worried about the competition, but because I know that blockchain is this like large network device where everything will happen, right? If somebody wants to run an IPO or he wants to run an NFT auction, then he will still like compete with me for block space. So even if he's not really competing with me on the trading, on the DEX trade, he's competing with me because he's taking us some block space because of the transaction that he wants to execute. And this is what we call the blockchain congestion. So now if we look at whether or not we would have revision of order on the mempool and what would be the trading profit under like explicit competition, implicit or blockchain congestion, we see that if really there is competition, either explicit or implicit, we expect the trading profit to be close to zero, right? Because of competition, like we are eating up all our profits because we have to submit larger fees in order to gain priority in the execution. Like if the competition is explicit, then there will be revision of fees in the sense that I will submit an order with a new order with the same nonce, but with a larger fee in order to gain priority. If the competition is implicit, instead, as I mentioned, I will just submit a large fee ex ante and I will not be revising this fee later on. Of course, if there is congestion in the blockchain, like you just want to execute to reduce to lower your risk. So what happens is that you expect not to revise your order, right? You are not really competing with other traders on the same trade, so there is no reason to revise your orders and submit a new order with the same nonce and with larger fee. But the trading profit, you will be, in this case, will be positive because I'm not really competing on the execution of these DEX trades. I'm competing to lower. I mean, I'm just trying to lower my execution risk. I want to get into the block, into the next block. So then we say, okay, let's identify trades. First of all, that are performing explicit competition. So how do we do that? We match executed trades with the previous mempool orders if they exist. And these are the criteria that we're using. First, like the matched order must have the same submission address and the same nonce as the executed trade. So we want to make sure that really this, if the competition is through revision of fee, it means that they must come, of course, from the same trader, and is like really submitting the order with the same nonce. So still the same trade, just that he wants to get more priority, and therefore he raises the fee. Of course, the gas price of the trade that is executed must be higher than all of its matched orders. So that means that a new order with the same nonce is resubmitted, increasing the fee until there is the execution. And we are always going in increasing, or in the fees always increasing, right? Because that's like what would mean that there is explicit competition. And also, like we look at the third condition, that we want to make sure that these matched orders are really referring to the same trade, in the sense that if like a trade is executed in block T, but has arrived, I mean, the mempool like long time ago, and long time ago it was submitted in the public mempool, and now the quote has been revised after 7 or 8 blocks. That means that perhaps it's not really indicative of competition, right? Because it's not really, ideally we want this competition to happen like in the same block or maybe into consecutive blocks, but we don't want to see a revision of quote for an order that was submitted a long time ago, because maybe that it may not have much to do with the current order. And what we see is, the first column 0 really refers to orders which satisfy, matched orders which satisfy all the T criteria, including the last criteria, which says that matched orders for the executed trade has arrived just before this block has been mined. Whereas when we see the second column, third column, and so on, these columns refer to matched orders which satisfy the first 2 criteria, but we are relaxing the third criteria. So this means that it could have arrived 1 block ago, or two block times ago, or 3 or 5 times block times ago, etc. But what we see is that the percentage of matched orders is really like lower than on the order of 1%. So that means that there are really there are like not many orders which are explicitly competing, right? Because it's on the order of 1%, and even if you include like a large time between the execution and the submission in the block, you get to around like 3% or 4%. So that means it's still a significant, it's a small percentage of the all trades that have been executed. But still, we are able to identify them for both stable, stable, not stable, not stable, and not stable, not stable. So then we say, okay, it's small, like that's what we have established by looking at the data, but they might still be driving our SVR results, right? It's possible that we are observing this high fee because of explicit competition. So what do? Like the simplest possible thing to do is to exclude these competition trades and re-implement the structural VAR. So just without the competition trades. And then we can look at the permanent price impact, which is essentially the cumulative input response of centralized exchange returns to changes or shocks to the trade flows. And we see that the results do not change much, right? Qualitatively, they are the same. We still see that the high fee DEX trade flows have a larger impact. They have a larger information share, a larger permanent price impact compared to the low fee DEX trade flows. So the results have not changed if we exclude this competition trades from the analysis. So definitely they are not the ones that are driving our SVR results, right? If they were driving the results, we would have expected to see changes here. Okay, so then we say we can because the cumulative response, input response of DEX trade flows is changed to centralized exchange return is also changing barely, right? So the other direction is when we shock the centralized exchange return, we want to see how what is the impact on the DEX trade flows, and we see that the results are also remain the same. Like for example, shocks to the centralized exchange return for stable coins are not really impacting the flow on the DEXs because the results remain statistically insignificant as they were before. And similar, and also we see again that for high fee DEX trade flows, the response to public shocks on the centralized exchange is larger compared to low fee DEX trade flows. So the results, basically the storyline is the same as what I was mentioning before. Okay, so now the next question is, okay, what about implicit competition, right? And as we mentioned before, if there is competition, then we expect the profit to be close to zero, right? Because competition means that because of competition, the profits are eaten away by the competing trades. So we want to measure the revenue here, and the revenue that the orders is making, and we look at the difference between the price gain, which is measured by the relative price impact, minus the price impact cost. And this is related to the previous question about transaction cost. This is exactly measured with this quantity, and minus the fee that has to be paid in order to transact on the DEX, which is the blockchain fee. So how do we measure the relative price impact and the relative the relative expected spread, which are essentially proxy for the price gain and for the price impact cost? Like for the revenue, for relative price impact, we look at the difference between the mid quote after the trade and before the trade, normalized by the mid quote at the trade. So here we have to be clear that there is no real mid quote on the decentralized exchange because there is no bid and ask price. You cannot do bid plus ask divided by 2. So the way we are measuring the mid quote is by looking at the exchange rate. So the exchange rate in the DEX, so the price of the ratio between the amount of reserves like Ethereum versus Bitcoin. If it's a DEX which is managed Ethereum versus Bitcoin, this would be the exchange rate. And for the price impact, we are looking at the difference between the price after the trade, the transaction price, which means if you think about the Uniswap bonding curve, after you trade, you are moving from one point of the curve to another. So this new point where you moved after you're transacting is what we denote by PT. and the exchange rate before the transaction took place is the mid quote. So essentially, if there is a large price impact after the trade because the curve is very convex, then PT will be very different from MT, and that means that there has been a larger price impact. So other price impact means more complexity, or also if the pool is very shallow, right, then there will be also higher price impact. So then we plotted the revenue distribution for stable coins, stable pairs, stable, unstable, unstable, unstable. And again, exploiting the distinction between low fee, middle fee, and high fee. And I just want to point out the revenue distribution and see, for example, a comparison between high fee. Let's look at this stable pair, like Aave versus Ethereum. So these are two unstable pairs. Aave is the Aave lending borrowing protocol, decentralized lending borrow protocol. Ethereum is the token for the Ethereum blockchain. So what you see here is that if you look at the distribution of revenue, you see that for high fee trade flow, the percentage of revenues which have a positive profit is larger compared to the low fee DEX trade flows, right? So that means that high fee DEX trade flows have a higher percentage of they basically generate higher revenue compared to low fee DEX trade flows, which essentially is excluding the implicit competition channel, because if they were bidding high fees because of competition, then we would expect that for high fee DEX trade flows, the revenues are basically negative, right, or close to zero. But here we see that there is a larger percentage of positive revenues compared to the low fee DEX trade flows, which basically excludes the competition story. It cannot be because of competition, because if it was because of competition, we would have expected definitely a higher percentage of trades with negative revenue in terms of the high fee trade flows. Okay, and this leads me to the conclusion. Like the main point was to show that what is the role of the fee in DEXs to convey information, and based on the analysis, we can conclude that high fee DEX trade flows are definitely more prevalent than low fee DEX trade flows. Like they have a larger information share, they have a larger permanent price impact, and also they are more responsive to innovation on the centralized exchange. So if there is a shock to the centralized exchange return, then these high fee DEX trade flows have higher sensitivity to that, and compared to the low fee DEX trade flows. In order to test what could be the possible economic channel, if we have used a data set of Ethereum mempool orders. So we got this data giving us exactly the history of transactions submitted to the public mempool and waiting for execution. And I think what we can conclude based on the current analysis is that informed traders or arbitrageurs which are just exploiting public information are not competing on the fee, but rather because we could exclude both the explicit and the implicit competition channel, our explanation, our story is that they must be fees because they want to maximize the probability of being included in the block. So they want to minimize execution risk coming from other transactions happening on the same blockchain, which are unrelated to the specific trades that the traders are executing on the DEX. So whereas this is another claim that we can make, but after Lian's question, we have to be more careful about how we define price efficiency. But to the extent that we can measure price efficiency on the centralized exchange and on the decentralized exchange in terms of speed of adjustment to shocks, either to return on to prices on the centralized exchange or to flows on the decentralized exchange, we can see that high fee DEX trades are playing an important role because they facilitate the price discovery process by incorporating information into the trades, and also they contribute to align prices between centralized exchange and decentralized exchanges. And yeah, with this, I would like to stop and thank you everybody for attending and also for the great questions that I got so far. And of course, if there are other questions, always happy to answer.
Yeah, are there more questions for the speaker? Yeah, seems like they asked no question in the middle of the presentation. Yeah. Okay, yeah, thank you very much. It was really wonderful talk. Yeah, thank you. Yeah, thank you to the speaker again, and also I want to thank to the participants for the active participation. Yeah, thank you.
Oh, thank you, and thanks everybody.
Mhm.
Good.
Yeah, thank you. Bye bye.
Thank you.